Assalamualaikum warahmatullahi wabarakatuh. Our group will be presenting about the Lehman Brothers US case. My name is Puteri Aisyah Binti Kamarul Bahrin, and I'll be presenting about the introduction about accounting fraud. So, what is accounting fraud? Accounting fraud refers to the deliberate manipulation of financial accounts or tax returns for the benefits of an individual or a business. So, accounting fraud occurs when a company intentionally falsifies financial documents. So consider a company that produces an estimate that needs later be amended. Accounting fraud did not occur because the errors were not intentional. So, for instance, a company might inflate revenue, understate costs, overestimate assets, or underestimate liabilities. So the following lists several instances of accounting frauds. Assume that the CEO of publicly traded corporation intentionally makes inaccurate claims regarding the company's prospects. So the CEO might face fraud charges from the Securities and Exchange Commission. Accounting fraud, on the other hand, does not exist because no financial records were fake. A person who commits accounting fraud could face legal action. So in this Lehman Brothers case, Repo 105, which was utilized to temporarily remove securities and problematic liabilities from Lehman's balance sheets while disclosing its quarterly financial results to the public, is essentially an aggressive and dishonest accounting of balance sheet method. Instead of being listed as loans, these transactions were recorded as sales. So next, I'll be presenting about a few terms. So the first term is the term tone at the top. So the term tone at the top, which is frequently used in auditing, refers to the leadership style and dedication to integrity and ethics of a company's management and board of directors. The tone at the top sets forth at a company's cultural environment and corporate values. It says that the organization's leaders should be sincere, exhibit integrity, and uphold an ethically sound business culture. In this case, the management encouraged taking undue risks. Lehman's chief risk officer claimed that many of her risk management tactics was disregarded by the upper management. Top executives believed their company was too sophisticated to fail and wanted to keep ahead of rivals who employed similar high-risk tactics. So next is the asymmetric information. So, the term asymmetric information describes a situation in which one party to a transaction has access to more information than the other. Because there is asymmetry in information in some transaction where the seller knows more about the good being sold than the buyer, so the seller may exploit the buyers. So, asymmetric information, commonly referred to as information failure, happens when one party to an economic transaction has greater understanding of a subject than the other party. If one party has information than the other and the other does not, so there is asymmetric information occurs in every transaction. So, market failure is allegedly caused by this. So, in this case, there is little evidence appears regarding information in the financial industry prior to the bankruptcy. So, in the final trading days before the notification of the bankruptcy filing, the adverse selection components increases for Lehman stocks. So, next is the role and responsibility of the board of directors. So, the board of directors is in responsibility for ensuring that the agent, which is the CEO, acts in the shareholders' best interest. A board member in a corporation is tasked with directing the organization towards a more sustainable future by implementing morally righteous and sensible management, decision and policies while decision and policies, while making sure the company has enough resources to carry out its objective. So, for a day-to-day management task, business must appoint a capable and accountable executive director or a CEO. Information is distributed asymmetrically between agents and principals, which contributes significantly to agency difficulties. So, in this case, Lehman Brothers appointed a number of independent directors who had no knowledge of how financial institutions should cooperate, which contributed to the company's failure. In Lehman, 8 out of 10 directors complied with NYSE independence rules in 2006, yet they lacked financial knowledge and were unable to effectively monitor Lehman. Poor risk and asset management by the corporate management was another factor in the failure. When the interests between principals and agents or investors and executives differ, the classic agency problems occurs. Executives want to keep their positions then to increase shareholders' returns. Lehman Brothers filed for bankruptcy in 2008 under Dick Foote's leadership, shocking the entire financial industry because it was the biggest bankruptcy filing in history. As Lehman Brothers is often cited as an example of corporate governance failure, largely due to poor oversight by the board. So next is the human bias. So I choose overconfident bias. So overconfident bias is the propensity to believe that one is better than other at accurately assessing risk or making other types of judgment and decision. The propensity is to give more weight experience or events that are immediately remembered or easily accessible than to those that are not known as the availability bias. As the real estate market started to tank in the Lehman Brothers, so the company relied on complex financial instruments built on rapid real estate expansion. Its its revenue uh, its revenue increased by 130% between 2000 and 2006 as a result of early success with mortgage-backed securities. Lehman Brothers acquired 5 mortgage lenders between 2003 and 2004. This is enabled it to originate and underwrite subprime loans, boosting its profitability. Lehman extensively invested in problematic loans and commercial real estate in March 2006, but instead of immediately selling them, it retained them on its books. The timing of the management decision to acquire these assets when real estate prices were declining could not have been worse. So next, last but not least, is the fiduciary duty of the board of directors. So the highest possible standard of care is referred to as the board of directors fiduciary duty. Board members and officials are fiduciaries, and as such they are required to act responsible by both statute and commonly law rules. The term fiduciary refers to a person who bears special duties in relation to the supervision, allocation, administration, and investments of real property such as the company's public or charitable assets as well as intangible assets, such as the company's public or charitable assets, such as its reputation and place in the community. The fiduciary duty, which includes the duty of care and the duty of loyalty to the company, requires directors to manage the firm in the best interest of the company and its shareholders and not themselves. So related to the case, the examiner discovered the evidence of the former CEO violation of fiduciary duty for failing to look into whether the business was misleading investors about its power by employing the Repo 105 repurchase and the sale program. So that's all from me. Thank you.
Assalamualaikum and hi everyone. My name is Nurzifhan Hanis Binti Zainuddin and today I will present about the fraud that happened in Lehman Brothers. First of all, Lehman Brothers is a former investment firm and one of the world's largest investment firm for 158 years. However, their involvement in using unethical accounting techniques and other accounting concerns caused it collapse in September 2008. Lehman Brothers was involved in multiple fraud cases, and we choose Repo 105 as our case study. So, how was Repo 105 perpetrated and concealed? So, Lehman Brothers purchased various mortgage during the time when the price of house rise quickly, and including the Aura Loan Services, a business that specializes in providing loans to customers without a complete documentation. And these loans then generated record revenues for Lehman Brothers between 2005 and 2007. However, the housing market began to fall apart in 2007, and because of that, homeowners being unable to pay their mortgage commitments. Due to the sudden rise in delinquencies that followed, Lehman Brothers had to write down billions of debts, and these bad debts left a significant role in their balance sheet company, in their company's balance sheet. Lehman Brothers had to deal with this problem and generate more money, or they would sell some of their assets to avoid a rating downgrading by the rating agencies. However, selling this asset was not a practical option because there was no ready market for them, and because the market valued them far lower than they were valued on the company's book. Lehman Brothers started a new strategy of action to make their balance sheet look stronger and disguise its excessive debt load and dangerous position from rating agencies. This strategy called Repo 105. What is Repo 105? 105 is a repurchase agreement. Transactions are typically used by business to manage their short-term cash requirements. However, in the case of Lehman Brothers, these transactions were intended to make Lehman Brothers' balance sheet appear greater and stronger than it was. The firm used this method to temporarily eliminate assets from its balance sheet, creating the impressions that the company had less debt than it actually did. In the days before the close of its financial quarters, the firm used Repo 105 to remove securities worth of billions of dollars from its balance sheets. Next is who were involved in Lehman Brothers Repo 105 case. Richard Flood. Richard Flood is the final chairman and chief executive officer, CEO of Lehman Brothers. And then you have Chris O'Meara. Chris O'Meara is the company's chief financial officer from December 2004 to 2007. Next, Erin Cullen. Erin Cullen is a Lehman Brothers chief financial officer. Also, Ian Lewitt, so the Lehman Brothers chief financial officer. Then, you have the auditing firm, Ernst and Young, which examine the financial records of Lehman Brothers, was also charged with the fraud by approving the balance sheet, by approving false financial statements, is accused of helping and hiding the company in use the Repo 105. When was Lehman Brothers start use Repo 105? So Lehman Brothers started use repo 105 regularly in the years up to its collapse in 2008, starting in 2001. The court appointed that Azman wrote in his report that Lehman Brothers used repo 105 three times in its financial statements. The whistleblower of repo 105 case is Mr. Matthew Lee. He was a former Lehman Brothers senior vice president who had been at firm for 14 years in the company. Mr. Lee sent a letter to the management regarding the repo 105 and other accounting concerns. That the letter informed the other top finance officers of Lehman Brothers that the firm's controls and financial statements had very serious issues. Other than that, six reporting accounting issues were listed in his drafting draft. The letter's objective was to get management's attention so that there would be an investigation if it was successful. However, he was fired unexpectedly 6 days after his initial letter, months before Lehman Brothers collapse. That's all from me. Thank you so much.
Assalamualaikum and good morning, afternoon, or good night, sir. My name is Isabella Binti Mohd Azman from AC40 Group 5, and now I will be presenting my part, which is the pressures, opportunities, and rationalizations of the Lehman Brothers. First of all, let's talk about the pressures. There are two pressures pressures that made the Lehman Brothers commit the fraud, which is first of all is the profit pressure. The profit pressure of the Lehman Brothers, known as the fourth largest investment bank in the world, had intense pressure to maximize profits and generate high returns for their shareholders. This is due to the fact that every day they have to have a cash flow of billions of dollars to keep their businesses afloat, and this causes them to have a very high pressure in making sure that their business is always running and there is always money flowing in and out. Second of all is the personal pressure. The executives at Lehman Brothers had significant personal financial investments tied up to the company's stock. They were particularly motivated to keep stock price high and avoid any negative news, especially their CEO at that time, Richard Full. Richard Full had done many decisions on making sure that their companies stay afloat, such as taking high risk leverage investments and taking very risky decisions in making sure that they can garner up the billions of dollars and even try to commit the fraud. Second of all is the opportunities. There are two opportunities in this case, which is the complex financial instruments. First of all is the trading of complex financial instruments such as the mortgage-backed securities, collateralized debt obligations, and credit default swaps. They were often difficult to value and had little transparency, meaning that the Lehman Brothers could use these instruments and twist their ways into making sure that they can get away with the fraud, such as the repo 105 transaction where they use this loophole as a loophole to commit the fraud. Second of all is the accounting rules loophole. The accounting rules for financial services companies were complex back then and allowed for a significant amount of discretion in how assets were valued and liabilities were reported. They used this loophole in the repo 105 transaction to get away, saying that it is still within the GAAP and they didn't do anything wrong because it is still legal. Now let's talk about the rationalization of the Lehman Brothers, which is they committed the fraud for a greater good of the business. To hide their unfavorable financial leverage to appear healthy to outsiders, so investors won't run. They do this because they thought, oh, maybe because this business is so big, so dominant in the investment industry, do it has to take desperate measures to make sure the business stay afloat. So they decided to commit the crime of doing the repo 105 transaction and fooling millions of people. Second of all is the rationalization that what they did is technically not a fraud. This is not fraud. They say that it's not fraud because it is considered as rather creative accounting or legitimate risk management, because what they did in repo 105 transaction back then didn't go against any of the accounting standards, but rather they just twisted it into their favor. Now, let's talk about the consequences, effects, and penalty imposed due to the case. First of all, let's talk about the auditors. Ernst & Young is the auditor for this Lehman Brothers during this case. So, as a effect of it and the penalties for the auditors, Ernst & Young paid $10 million as penalty to investors and a lawsuit of 150 million in fees of what they garnered between their service in 2001 to 2008, and they were also banned from consulting for New York regulated financial institutions for 6 months. Second of all, the company. The company Lehman Brothers became the biggest bankruptcy case in US history, which causes massive job losses and loss in investments. They were also sued by investors and had to pay out millions of dollars in settlements. These consequences made them in debt by $619 million. Next is the management. For the effect and consequences of the management, it is the collapse of the CEO, Richard Fuld. He is known as the Wall Street Gorilla, but during this case, he could not get away with it, even though he said that he didn't know that he was committing a fraud, but is within legal means. So he was not perpetrated by law. But however, he was heavily criticized for making such risky investments. However, the court decided that the financial collapse wasn't in his was out of his control and find it as a failure in the financial institution and not entirely his fault. Second of all is the Erin Callan, who is the chief financial officer of Lehman Brothers. She was criticized for being underqualified to handle the bigger finance finance management in the business. So the company management was heavily scrutinized as the consequences. Next is the shareholders. Investors were concerned of the Lehman stocks plummeting, so they lost confidence when the company filed for bankruptcy. Due to the billions of dollars that Lehman Brothers case lost, investors were forced to burden the loss, and they tried to sue the company and won a $10 million of compensation. And lastly is for the other relevant parties. There is a ripple effect in the global financial system as it caused a wave of bank failures, because Lehman Brothers is still was the fourth largest investment banking in the world. So many of the banks were interrelated and did business with this bank. So when this bank collapsed, a lot of other American banks also collapsed, which caused the government to try to revive them. However, the government could not revive the Lehman Brothers. So they decided to make new regulations as an effect of the case, which is the Dodd-Frank Act was established to reduce this risk of happening again, reduce the financial crisis to ever happen. And that is all from me. Thank you. Now I would like to pass to the next person.
Hello everyone, I'm Sangkeetha Pubalan and I'm here to present our conclusion for this case. Firstly, the collapse of Lehman Brothers had a significant impact on independent auditing. Even though an accredited accounting firm audited Lehman Brothers, concerns were raised regarding the auditor's independence and willingness to investigate management's assumptions and forecasts. The situation made it obvious that to ascertain the reliability and accuracy of financial accounts, and also the auditors must preserve their independence and be prepared to criticize management when necessary. Next, the case highlights the need for transparency in financial reporting. Large financial institutions' financial reports and lack of transparency generated questions about their trustworthiness and integrity. To avoid further mistakes in this nature, the auditing profession must continue to emphasize the importance of financial reporting transparency. Furthermore, the collapse of Lehman Brothers highlighted the significance of risk management in financial firms. To identify and manage risk effectively, financial institutions must have robust risk management system in place. Auditors recommended to investigate the procedures and safeguards the financial institutions used to identify, evaluate, and manage risks. By taking these steps, auditors can help prevent similar events in the future and promote a more stable and safe financial system. Finally, the collapse of Lehman Brothers emphasized the importance of audit committees. Lehman Brothers Audit Committee was criticized for failing to supervise auditors effectively and question management assumptions. Robust and independent audit committees are crucial to maintaining the accuracy of financial reporting. Auditors must analyze their work, assess its quality, and ensure they have the necessary tools and assistance to perform their job effectively. In simple words, this case highlighted the critical role that auditors, audit committees, and worldwide auditing standards perform to safeguard the accuracy, reliability, trustworthiness, and transparency of financial reporting. It also showed how financial institutions, legislators, and regulators must work together in a coordinated manner to manage systematic threats and enhance financial stability. Last but not least, I would like to present the lesson learned by us when completing this assignment. Over reliance on financial frameworks and assumptions contributed to the collapse of Lehman Brothers. Complex financial models exaggerated the risk of mortgage backed securities and other financial instruments, which proved to be inaccurate. Many financial institutions and regulators relied heavily on these models to make crucial decisions, such as establishing capital requirements and assessing asset value. The Lehman Brothers bankruptcy serves as a cautionary tale, highlighted the importance of truly examining and reviewing financial models and assumptions. Financial institutions and regulators must be aware of the limits of these models and take broader range of perspective and information into account when making decisions. Lessons from the Lehman Brothers case can be used to improve the adaptability and sustainability of the financial system. That's all from us.